Imagine you are the CEO of a successful, growing startup. You have spent 10 years building your capital, refining your strategy, and protecting your assets. You are finally profitable. Then, one day, you decide to bring on a co-founder. You sign a contract that gives this person unrestricted access to the company bank account, 50% equity in everything you have built so far, and 50% of everything you will ever build in the future. You also agree that if this partner decides to leave the company for any reason or for no reason at all, they can take half the cash, half the intellectual property, and potentially force you to pay them a salary for years after they are gone. Oh, and you didn't run a background check on their financial history, you didn't look at their resume, and you didn't ask to see their credit score before signing the deal. You just signed it because you had a good feeling about them. If you did this in business, you would be fired by your board of directors. You would be called reckless. You would be laughed out of Silicon Valley. But millions of people do this exact same thing every single year. We just don't call it a merger, we call it marriage. And while we obsess over asset allocation and expense ratios in our portfolios, we ignore the single legal contract that has the statistical probability to destroy more wealth in one afternoon than a stock market crash could destroy in a decade. My name is Bobby, and I spend way too much time dissecting the invisible risks that threaten to wipe out the wealth of the middle class. If you are someone who is thinking about getting married, or if you are already married and fighting about money, or even if you're single and building your empire, make sure to hit that subscribe button and give this video a thumbs up if this helps you out. Because today, we are going to take the romance out of the equation for a few minutes. We are going to look at marriage through the cold, hard lens of forensic accounting. We are going to discuss the spender risk, the terrifying math of divorce, and why the person you choose to wake up next to is statistically 10 times more important to your net worth than the S&P 500. Here's the thing about marriage that nobody tells you during the engagement party. In the eyes of the law, marriage is not a union of souls. It is a financial partnership. It is a legal merger of two economic entities. When you say "I do," you are triggering a cascade of tax laws, property laws, and liability statutes that bind you to another person's financial behavior. Most people spend more time reading the terms and conditions of a new iPhone update than they do reading the contract of marriage. They walk in blind, guided by dopamine and oxytocin, completely ignoring the balance sheet. And this is dangerous because financial incompatibility is the silent killer of wealth. We are taught that opposites attract, and maybe that works for hobbies or movie tastes. But in finance, opposites do not attract, they attack. If you are a saver, someone who derives safety from liquidity and compounding, and you marry a spender, someone who derives dopamine from consumption, you are not just entering a relationship, you are entering a war of attrition. Let's look at the math of the slow death. This is what happens when you marry a spender. It isn't an immediate explosion, it is a slow bleed that prevents you from ever reaching escape velocity. Let's say you are disciplined. You save $20,000 a year. Over 30 years at 8% interest, that's over $2 million. You're a millionaire. But you marry someone who believes that money is for spending. They don't have a gambling problem, they just like nice things. They lease a luxury car every 3 years. They insist on the more expensive vacations. They buy lunch every day. They buy gifts for everyone. These micro decisions add up to maybe $15,000 a year in extra spending. Now your household savings rate drops from $20,000 to $5,000. Run the math on that. Saving $5,000 a year for 30 years gets you about $500,000. The spender tax cost you $1.5 million. You didn't lose that money in a divorce. You lost it because your partner's consumption habits acted as a parasitic drag on your compounding. You were trying to fill a bucket while they were drilling holes in the bottom. And the psychological toll of this dynamic is devastating. You become the bad guy. You become the no police. Every financial conversation becomes a fight, so eventually you stop fighting, you surrender, you accept mediocrity because the friction of excellence is too high. You watch your dreams of early retirement evaporate one Amazon box at a time. But the slow death is actually the better option compared to the sudden death, which is divorce. We have to look at the statistics without flinching. The divorce rate for first marriages is roughly 40 to 50%. For second and third marriages, it's even higher. That means that statistically, marriage is a coin flip. Imagine if I told you there was an investment that had a 50% chance of returning 10% a year and a 50% chance of losing half your principal instantly. Would you take that bet? Most risk managers would run screaming, yet we take this bet with our entire lives. When you divorce, the economy of scale is shattered. This is simple math. When you are married, you have two incomes supporting one household, one rent, one electric bill, one internet bill. That's efficient. That creates surplus cash flow. When you split, you now have the same income supporting two households. Your overhead doubles instantly. You lose the efficiency. And that's before the assets are divided. Let's talk about the divorce destruction calculation. Let's say a couple has a net worth of $500,000. They divorce. In many states, that's split down the middle. So you walk away with $250,000. But wait, you forgot the transaction costs. Lawyers are the only ones who win in a divorce. A contested divorce can easily cost $50,000 to $70,000 per person in legal fees. So now your $250,000 is down to $200,000. Then you have to sell the house. That's 6% in realtor fees, plus closing costs, plus moving costs. More wealth evaporated. Then there's the liquidation of assets. If you have to cash out a 401k or sell stocks at the wrong time to pay off a settlement, you trigger taxes and market losses. By the time the dust settles, a divorce can effectively destroy 60 to 70% of your purchasing power. You are back to square one, but you're 10 years older and you have half the time left to compound. And we haven't even touched on alimony and child support. These are fixed costs that follow you for years. If you are the higher earner, you might be legally obligated to pay your ex-spouse thousands of dollars a month to maintain the marital standard of living. Think about that phrase. The law essentially says that even though the partnership failed, you are still responsible for funding the lifestyle of the other partner. It turns your ex-spouse into a long-term liability on your balance sheet, like a bad debt that you cannot discharge in bankruptcy. I have seen high earners making $200,000 a year, living in studio apartments and eating ramen because after taxes, alimony, and child support, their disposable income puts them below the poverty line. They are generating wealth, but they are not keeping it. They are indentured servants to their past relationship. Now, you might be thinking, Bobby, this is cynical. Marriage is about love, not money. And I agree, it should be about love. But money is the #1 cause of divorce. Financial stress is the acid that eats away at love. If you want a happy marriage, you have to get the money right. You cannot build a stable emotional life on a cracked financial foundation. The irony is that by treating marriage like a business decision before you walk down the aisle, you actually protect the romance. You remove the single biggest stressor that kills relationships. When you and your partner are aligned on the numbers, you stop fighting about the past and start planning for the future. This brings us to the concept of financial infidelity. This is when one partner hides debt, hides spending, or lies about money. A survey found that something like 40% of Americans have committed financial infidelity. This is terrifying. You are legally liable for your spouse's debt in many scenarios. If they run up a credit card or take out a loan, creditors can come after the marital assets. You could wake up one day to find a lien on your house because your partner had a secret gambling habit or a shopping addiction. You are tethered to their credit score. If they tank their score, you can't get a mortgage. You are swimming with a partner who is secretly tying weights to your ankles. You need to know this before you jump in the water. So how do we de-risk this massive decision? How do we prevent the merger from failing? The first step is extreme financial vetting. You would never hire a CFO without seeing their resume and checking their references. You need to do the same with your partner. I know it's unromantic, but you need to have the money date. Before you get engaged, you need to open the books. Show me your credit score. Show me your student loans. Show me your credit card balances. Show me your spending habits. You need to look for red flags. Does this person view debt as a tool or a lifestyle? Do they have an emotional need to spend money to feel good? Do they avoid opening mail because they're afraid of bills? These are not quirks. These are structural defects in the partnership. You cannot fix a person who doesn't want to be fixed. If their financial values are fundamentally opposed to yours, you cannot marry them. Period. It will not work. You will spend your life bailing out their boat. The second step, and this is controversial but essential, is the prenuptial agreement. There is a stigma that prenups are for rich people or people who plan to divorce. That is nonsense. A prenup is simply an insurance policy. You don't buy car insurance because you plan to crash. You buy it because driving is dangerous. Marriage is dangerous. A prenup forces you to have the hard conversations while you still love each other. It allows you to define what is ours and what is mine. It can protect your premarital assets. It can protect you from your spouse's debt. It can pre-negotiate alimony so that you aren't at the mercy of a judge who doesn't know you. A prenup is a love letter to your future self. It says, I respect you enough to define the terms of our partnership clearly. If your partner refuses to sign a prenup or refuses even to discuss it, that is a massive red flag. It means they're banking on the state's default divorce laws, which are often archaic and unfair. However, I want to flip the script for a second, because if you get this right, marriage is the greatest wealth hack in existence. It is the superpower merger. Two high-income earners with shared values living on one income and investing the other is the fastest way to become wealthy in America. It is the dual income, no kids phase, or even the dual income, no lifestyle phase. You get economies of scale. You split the rent. You share the car. You double the tax advantage space. 2 401ks, 2 IRAs. You have a built-in accountability partner. When one person wants to spend, the other talks them down. When one person loses a job, the other keeps the ship afloat. A financially aligned marriage is a fortress. It is unstoppable. The goal isn't to avoid marriage. The goal is to avoid a bad merger. Here's what most people don't realize. The stay-at-home spouse is also a financial decision. If one partner stays home, they are sacrificing their earning potential and their career trajectory. This is a massive contribution to the household, saving on childcare, managing the home. But it is also a massive risk for the non-working spouse. If the marriage ends, they have a 20-year gap in their resume. They have no 401k. This is why the legal system awards alimony, to compensate for this sacrifice. If you are the working spouse, you need to understand that you are essentially employing your partner to manage your life, and that comes with a severance package liability. If you are the stay-at-home spouse, you need to ensure you are protected, perhaps by having a spousal IRA funded every year. You need to treat the household as a business where both employees are compensated, even if one is paid in sweat equity. Ultimately, the decision of who to marry is an asset allocation decision. You are allocating your time, your emotion, and your future earnings to a single stock. Do not pick a penny stock. Do not pick a meme stock. Pick a blue chip stock. Pick a partner with a track record of stability, growth, and dividends, emotional support. You want a partner who compounds you, not one who discounts you. So here is the actionable play. If you are single, add financial literacy to your list of deal breakers. It should be right up there with kindness and attraction. If you are dating someone, stop avoiding the money talk. Ask them, what does wealth mean to you? Watch how they answer. If they say buying a Lambo, run. If they say freedom and security, keep listening. If you are already married and you realize you have a spender problem, you need to intervene immediately. You need to separate the finances. Create a yours, mine, and ours system. Automate the savings from your paycheck before it hits the joint account. You have to build guardrails to protect the household from the spender's impulses. You cannot just hope it gets better. Hope is not a strategy. Marriage is a high-stakes game. The upside is infinite, but the downside is total ruin. Treat it with the respect it deserves. Do the due diligence, read the contract, and choose your co-founder wisely. Because a broken heart heals, but a broken retirement account lasts forever. If this video made you realize you need to have a serious conversation with your partner tonight, share it with them. Frame it as building our future, not fixing your problems. Thanks for watching, and I'll see you in the next one.